I was asking about these inflation concerns affecting the markets already. How much economic and earnings growth will you need to see in order to offset all of these price pressures?
Well, I think we're getting ample economic and earnings growth now. If you just look at the 8% of the S&P 500 companies that have reported as of Friday, 4 out of 5 beat estimates, and their earnings in aggregate were 15% above estimates. The 5-year average beat is about 8%. So the big cost scare is simply not materializing yet.
We are seeing the bond markets already start to move. The Australian 3-year yield at the highest since February 2020. Same thing with the 2-year here in the U.S. at the highest since February of 2020 as well. Kiwi yields also continuing to rise given the CPI numbers. What are the implications of rising yields for the broader asset classes in Asia?
So far, the markets are happy with the bond yields going up, and what we're seeing is the recovery play is coming back, and that's congruous with the idea that yields are rising, because if yields are rising in response to an improving economy, then the market is okay with that, and I think that's what's happening now.
Mark, when it comes to China, you say this is a situation with Evergrande where they can just throw money at the problem. So if they've left it to local governments to sort out, it's not a systemic issue. The PBOC is not worried about it. But it doesn't fix the longer-term structural drag on growth, does it?
Well, I agree. It's a third. Real estate is a third of the Chinese economy, and it's the big elephant in the room. And I am reminded of the global financial crisis. I hate to say it, but I'm just reminded that Business Week ran a cover story about subprime loans back in September 2006. You can find it on the internet. And the title was Deceptive Loans, Phantom Profits, a Coming Wave of Defaults. That was 2006. So as we all know, the crisis didn't happen until 2008. I'm also reminded of 2007 when Ben Bernanke and Henry Paulson said that from the standpoint of the overall economy, subprime mortgages were contained. So that's the issue with these sorts of elephants in the room, is that there could be a crisis, but the timing of it is impossible to predict, just like Business Week was two years too early back in 2006.
For a minute there, I thought you were going to say this is just like Lehman. That kind of takes us to the question of the day, which is, of course, looking at the data dump out of China today, domestic activity indicators, that weakness in retail sales in particular, and the broader GDP piece. How does that potentially impact the performance of various assets for you?
In a very big way, because China is a third of global growth. And I think what we're seeing now is, by the way, I have to give credit where credit is due. There was a very good article on the leading political theorist in China, Mr. Wang Huning, in the Palladium magazine last week. And it's being sent around. I've received it from lots of friends. Anyway, the idea is that they're trying to rewrite the social contract in the country. Kind of between the billionaires and the Communist Party, and if you use ancient China as a sort of example, between the merchant class and the mandarins. Anyway, anytime you are trying to rewrite a social contract, I mean, that's a pretty big deal. And so I do think it's moving toward a more paternalistic style of society and economy, which by default means less laissez-faire, less of the hyper-capitalism of the previous 20 years, and therefore lower economic growth.
Of course, he's the man behind, common prosperity and a lot of these other slogans that have gained popularity in China over the previous years as well, right? So where does that leave the middle class? Where does that leave the Chinese consumer?
Well, I think in a very good place. And you know the old saying, when in Rome, do as the Romans do. Basically, common prosperity means that I think it'll become a nicer place to live, actually. It'll be greener and cleaner and less of a rat race. But I think it'll also have a bigger middle class. And so we can invest in mass consumption as a proxy for that. I think it's the way to go. And it's not going to have the kind of returns on equity that the consumer technology giants had over the last decade, which, by the way, were really unprecedented in the history of capitalism. The returns on equity will be much lower, but they'll be there nonetheless. And that's, I think, yes, absolutely, invest in the middle class in China.